G'day. Travis Latter from Infinity Business Brokers, here with Brendan Hay, Director at Oracle Business Accountants. And today we're going to talk about RTO owners using their business as their private ATM. How are you today, Brendan?
Oh, excellent, Travis. Thanks for having me on. Well, thanks for discussing this with me.
Yeah, look, it's something we see a bit, isn't it, in the RTO world? And I'll give you an example. I've got one business at the moment that is got revenue for the year of $2 million. So based on sort of market guide, that should be around a $500,000 net profit. Now, when I look at the financials, the net profit actually says minus 51,000.
Okay.
But going through, there's $529,000 of adjustments, bringing the EBITDA to $477K. Now, you're now an accountant for a buyer. When you see those financials, what's the first thing you think of?
The directors or owners have been treating it like a personal bank account. It probably indicates or raises concerns about the disclosure of information in the profit and loss, the way things have been reported. It generally just demonstrates, well, to me, it would demonstrate a lack of internal controls, or a lack of internal controls in regards to how information's been reported and stuff like that. Just concerning to start with, without going into exactly what that looks like. Yeah.
So if you were advising that RTO that was coming up for sale, how would you advise them to make sure to put their business in the best position to be able to attract the right buyers?
And you and I have discussed this because we have one on the go at the moment, and the reality is, if we'd made a decision to sell 3 years before selling, then we would have started to perform and improve the disclosure and the figures to make it absolutely consistent from year to year. Make sure it meets the requirements regarding, ATO, tax disclosure, stuff like that. But look, I don't have a problem with, having some expenses like motor vehicle expenses and some stuff like that go through the company, provided there is some link to business related. But the reality is, I would recommend a client prepare 3 years before, putting it on the market, and really tightening up and becoming consistent. Like, you don't want to have to explain to a potential buyer or their accountant why expense accounts are going up and down all over the shop, and sorry, we put it here this year and over there next year, etc. That just doesn't give any certainty or any assurity to a buyer.
I totally agree with you. Sorry, mate, go on.
No. That's where I believe.
Yeah.
That's where I would start. Is I would have a strategy in regards to the exit strategy or the succession strategy in place, and then you execute accordingly.
So quite often, I'd have to say RTO owners don't prepare 3 years in advance to sell their RTO. So how could a vendor clean up their accounts in a shorter period of time before selling?
Well, then they'd have to be able to justify their add backs. So I think you definitely have the last year performing as if you were ready to sell. So I would make sure that the last year is exactly correct, or the way you want to present it. Like, I'd try and eliminate add backs out of the last year as a starting point. I certainly wouldn't want to have big add backs in the final year. And I think then you could potentially work your way back from there and have add backs in the previous couple of years. But I would certainly want to eliminate them out of the last year.
Yeah, and I think you touched on something before about having consistent figures. There's too often they move. At one time they're called this and they're called something else, and you can't have that visibility. And I know, and you've dealt with many buyers as well, that all you want is to be able to see, because buyers won't believe what you tell them, but they'll only believe what they can see and what could be validated. And having numbers moving all over the place is one of the biggest mistakes I think that vendors make prior to selling.
An example we've got together is that we've got contracting and consultant expenses, and we've kind of used them willy-nilly within a year, let alone over 3 years. I mean, the figures aren't going there consistently month to month, let alone year to year. So it's very hard to explain that and have credibility around a table with a buyer when you're kind of having to explain that. I mean, your credibility goes through the floor, and that's the important aspect, I think.
Absolutely. And I don't think enough vendors rely on their professional advice given to them and sort of discuss ahead of the time what their 12, 24 months of plan. Because I'm sure if someone came to you and says, Brendan, I'm looking to sell within the next 2 years, you'd go, right, let's start cleaning your books up now. And you've got to stop using it as a private ATM, because a buyer who sees you using it as a private ATM is never going to see the true value in the profits. Would you agree with that?
100% agree. And even the point of salary and wages, and if you've got non-executive directors taking salary and wages out of there, and then you add them back at the end, and you sort of say, well, I haven't done any work. Well, honestly, what's a buyer going to say? I don't believe you. And they're going to want to put them back into salary and wage because they will believe that they will have to replace you. So, take your salary, or take your salary some other way. Take it as a dividend after the profit. You know what I mean? So at least that way you can explain, well, I'm not working in the business. That's where I get the profit out, is through dividends, and there's better ways to do it. But you can't just I would prefer to see it done like that than try to explain away, I'm not involved in the business scenario, knowing now we've gone with potential buyers. They're very, very strict in regards to that sort of thing.
So I've sort of got a 5-step process that I want to share, and I want to get your comments on it. First one is engage with professionals. Second one is implement consistent practices and approach. The third one would be to reconcile regularly.
Yep.
The fourth one would be to avoid last-minute money being taken out personally that can't be shown. And probably the last one is again, just be realistic. And whilst you've got a tax advantage and an advantage of running the expenses through the business, you've got to think of that bigger picture. You got any comments on that?
Oh, look, I agree with what you're saying, and to take that reconciliation one step further, I mean, I agree with what you're saying, and I think you've actually mentioned them in a logical way. I mean, obviously, reconciling monthly is something that should be happening anyway, right? But you shouldn't just be reconciling the bank. I mean, there's other accounts that need to be reconciled. Debtors, creditors, loan accounts, inter-entity transactions. I mean, because as we know, that there's generally a service entity and a trading entity, or however. So we need to make sure inter-entity loans are reconciled. That's important. I liked where you said about not taking out the last minute, because we've had issues where we've earned income, and because the sale might have been a mid-year, we were trying to claw back or get the first 6 months profit out. Well, if that's how you're going to do it, make sure you start doing it before you walk into the meeting with the buyer, rather than have the meeting with the buyer and then start to try and renegotiate or that's my profit, and it's too late. You've already commenced the negotiation, or they've got a certain expectation in mind. To start changing their expectations, doomed to failure. You know what I mean? I think that's something critical. Expectations around what it's worth and what they're going to get for it is critical as well. The one thing I didn't hear you mention, you had 5 plus A, board meetings or management meetings, strategic direction, and what they're monitoring regarding success. You know what I mean? Like, and we're talking RTO, so student numbers, course take up, curriculum building, all these sort of things, strategy items or things they should be monitoring. And a buyer will want, as we know, a buyer wants to see pipeline. They want to see what's coming into the business. They want to see what the next 12, 18 months looks like, what courses are successful, what courses are having drop off, what you're looking to replace with. Those kinds of things are critical. And what it means, Travis, in honesty, is that the comment regarding experts. If you don't have the capability in-house, then you've got to have an expert externally to help you with doing that. Now, I mean, if you've got a $4 or $5 million turnover business, they may not have a fully qualified accountant, or they may not have a seasoned general manager with RTO experience, etc., etc. If you haven't got those things in place, then get an advisor or get someone on a board or get something so as you can demonstrate you've got that capability. Because if you can't, it just leads to issues through the due diligence process.
Yeah, so certainly does. And look, thank you so much for your time today. It's always a pleasure talking to you, because I learned so much, financial literature and literacy from you. So thank you so much for everything.
Can I just give you a plug? The involvement you've demonstrated in regards to the transactions I've been involved in, had they gone to you earlier and got you to advise them on certain aspects of their business or what they needed to be looking at, the transactions would have been a lot smoother, and potentially they would have got the outcome they were hoping for rather than the outcome they got. So, I mean,
thanks.
Yeah, you're welcome, because I've enjoyed working with you too. Thanks, Travis.